In this chapter, we'll talk about the housing market, and related to that, we would talk about the housing bubble, basically that market um, falling into dysfunction. Um, Now, this lecture, these slides, obviously not made by me, but these slides were originally made in 2018. And to be honest, as I reviewed them before making this lecture, they're actually already pretty dated because these slides were made before COVID. And while the housing bubble it's referring to is the 2008, 2009 economic crisis housing bubble, some may think that another housing bubble has now more recently emerged. But we'll try to talk about that as well. Okay. So, especially in a place like Hawaii, um, we ask this question quite a bit: how much is a house really worth? Um, Now, before moving to Hawaii in 2015, to be honest, I hadn't really ever, well, I'd never owned a house. I finally do own a house now, but um, when I moved here, I do remember just quite like just kind of initial shock the first time someone said that a house in Hawaii cost $1 million, because you hear that number a million and you're like, there's no way I would ever have that much money to get something. Um, and comparing it to a place like, again, like where I came from, Wisconsin, where you could buy probably about six houses or seven houses, pretty nice houses, for $1 million. So while the amenities of the home obviously are one of the factors that determines how much a house is really worth, it really truly is the idea of location, location, location. Um, there's a sort of a network effect to that gives a house a value in that it's determined by what all the how much local businesses are, what's the public transit like, um, who lives in the area, what's the crime like, what's the schools like, etc., etc. Or in a place like Hawaii, part of the thing that's determining the value of the house is who are the actors that are involved in demanding the houses. In a place like Wisconsin, you're not you're competing against just other people who live in the area, right? You're not, and maybe some small time investor who maybe is going to rent it out, but those would be probably pretty far and few between. Whereas in Hawaii, especially on Maui, where almost all of the demand on Maui is from investors. Um, in Oahu, you know, the investors are there, but um, to be honest, people that want to vacation in Hawaii are not probably vacationing on Oahu. It'd be um, Maui and maybe Kauai, maybe. But they're not. They're probably not vacationing. They're not. They're not buying an investment property on Oahu. Um, how much a house is really worth? That kind of calculation has also become a lot easier to determine the value. Obviously, with Zillow, right? Zillow, we get the Zestimate, and um, that kind of helps us shape um, what something is worth. So even if I just looked at my current location, so I'm at work right now. Okay, well, let's just type it in. Sure, something. So, even on the leeward side, where at least things would be somewhat affordable, you're still talking about um, houses, obviously less than $1 million, but still pretty expensive, considering where you're buying the house, right? Nothing wrong with the leeward side. It's just that almost all of the jobs are in town, and the commute to town, yeah, I know, maybe there'll be rail, but the commute to town is a pain in the butt. Um, if we just try to um, kind of see what's going on here. It looks like if I wanted to buy something near campus, isn't this the I think that's the golf couple A golf community. So 935,000, couple A Milani neighborhood. Near the rec center. It's been on the market 35 days. What, 1,300 square feet, 3 bedroom, 3 bath. $1 million, pretty much $1 million. Yeah, it's pretty expensive. Yard looks like it needs some work. Yeah, but you got a nice little hammock. And, the yard is small, but yeah, you can deal with it. But still, that's $935,000. That's a lot, considering that it's 1,300 square feet. Okay. So when we look at what houses are selling for, the classic index that's used is called the Case-Shiller index. And what we can see is that by different metropolitan areas, we see the same general trends of increase. But if you look at this, housing values in many cases have returned to what they were previous to the 2008 2009 crisis. As much of a crisis and the bursting of that bubble it took only 10 years for the most part to get back to that for most of the cities. And then the cities where that was never encountered. So in this case, it looks like it's Cleveland. Cleveland just never really had the bubble, and nothing really ever happened there. If we want to look at it here, I'll look at it from 2018. So this is, we can get the data from Fred. Yeah, that's pretty scary. Let's change this. Let's change it so that the base year is the housing bubble. Actually, no, let's do the start of it. That's scary. So basically, yeah, by the time the slides are made, basically the market was back to where it was before the housing bubble burst, and now it's obviously now 60% greater than what it was at the bubble. Okay, let me just pause this here. Okay, so obviously you see during the pandemic here that things dramatically increased. Whereas some 10 years after the financial crisis, the national home price index was only about 24% higher than it was at the peak. We've obviously seen a notable uptick here, which obviously not going to be in the slides, but part of the discussion then would be is do we have another housing bubble being created? Um, Possibly. We'll look at that in a little bit more here, a bit more detail. So let's talk about how um, housing is financed. Um, it used to be the way that the traditional mortgage, this is actually what I have too. I have just a traditional until the late 80s kind of mortgage. Um, I put down 20% and I got a loan for 80%. And it's a 30-year fixed rate mortgage. And so I know what my payment is for the next um, 30 years. Um, the the challenge, of course, is coming up with the 20%, especially if you've never owned a house before, because somehow, um, how are you going to come up with that kind of money? Because it's now 20% of a much bigger number. And quite frankly, the only way I was able to buy a house um, was that I bought it in the middle of the actual lockdown period when you couldn't even go and like tour houses, like they weren't doing open houses. So the only way you could basically buy a house during the actual lockdown was, having your real estate agent and having a one-on-one appointment to see a house, and obviously having to follow all the COVID criteria. Um, it was for any of you in this class who've bought a house. I mean, I can say it's the most stressful thing I've ever done. It is stressful on so many levels. It didn't help the fact that my wife was a few months pregnant too, so with our third child, so there's all the stress that comes with that as well. But um, it was stressful, really stressful, and it's nowhere near what it would be like today, because we didn't have to like bid against anyone or compete with anyone. The buyer the seller of the house was kind of desperate to sell the house. So, we did inspections, things came up, and we got money to fix them. None of that could happen today. The market is just so dramatically different. Um, Even just a few months after we bought the house. Um, and I feel that like if I had not been able to buy the house in that kind of way, given that I didn't own a house before, I probably would have had to use the 90 to 100% loan to value. Now, what that basically means is you're putting down less than 20%. Banks are willing to lend out more of the money in a market like Oahu, where they know they can sell the house pretty quickly if they had to. If the buyer stopped paying the mortgage, but it's just more expensive to buy it this way because essentially what you're getting is more likely than not what you're getting is 80%, and then you're getting a bridge loan that covers the remainder of the up to 20% value. So you basically have kind of like two mini mortgages. Once you get down to 80%, you no longer have to pay the PMI. um, that would be basically the mortgage insurance. um, Once you get down to 80% value, once you get down to 80% value, that the bank basically knows that whatever the costs are to selling the house, it knows that it would be able to make back all its money. Um, and in Hawaii, things are complicated just a bit further, um, and the reason for that further complication comes from the fact of um, you know um, how housing is or how and why banks do what they do. Um, so typically, at least on the mainland, what happens is that when a bank makes a mortgage on the mainland, um, they make the loan, and then the federal government swoops in and buys the mortgage from the bank. It's supposed to help the bank because then its money isn't locked up in this 30-year loan. It can go on and start lending money again and again and again. And then the two companies you've probably heard of, Fannie Mae and Freddie Mac, are these government sponsored entities which basically buy the mortgages and service many of the loans. The reason why in Hawaii we don't typically hear about these two companies that often, Fannie Mae and Freddie Mac, is because they don't deal with mortgages that big. In Hawaii, we typically have what are called jumbo mortgages. And jumbo mortgages means that it's outside of the limits of Fannie Mae and Freddie Mac. Um, so in my case, the bank owns the in my case the bank owns my mortgage. I make my payment by going to a branch and making the monthly payment. Um, I know for a fact that my mortgage was financed out of deposits. The bank has more than enough money to do that. So my mortgage ended up being with um, Central Pacific Bank. Um, I was actually going to go with Navy Federal, um, but it was taking it would take them too long. The guy just wanted to close really fast. He needed the money. I guess he was that desperate. The guy selling the house, he was that desperate, and so it got to a point where we just went with Central Pacific, which was okay, but um, in neither of those cases, those banks would have to hold on to the loan. Um, Now you face a lot of choices as well with these mortgages. So you can get, um, when I look at a typical statement that I get from the bank as I make the payment, I am paying more in interest every month than I am in making a principal payment. Kind of depressing. And it's going to be like that for at least 10 years, where my interest exceeds my principal payments. And I intend to stay in the house until the very end, until I'm dead. Um, Now, if I were going to flip this house, I probably wouldn't want to pay down anything in principal. So then I might want to do something like an interest only loan. Borrow all the money needed to pay for the house, do 100% loan to value, and just pay interest. Because the idea is that I will then put the money into the house to flip it, and then pay back the loan, having only had to pay the capital costs, the interest costs. And then you can even do something riskier than that if you didn't think that was risky enough. And that is you could have a negative amortized loan. So the reason why the interest only type of loan is riskier is because you basically your um, total amount owed is going to go up because the principal isn't falling. So you're going to be adding, um, the interest that's being applied to it is pretty much staying the way that it is, right? Because the principal amount is staying the same, and if the interest rates rise, you bear all of that cost because it's probably not going to be a 30. It's not going to be a fixed rate mortgage if it's interest only. It's going to be a variable interest. In negative amortization, it's even riskier because now you're not even paying all of the interest. Now it's actually adding on to your loan. You're capitalizing part of the interest. Um, to engage in negative amortization, you truly are um, confident about the future of the housing market and how well it's going to do. And you can kind of see these kinds of examples here. Um, this a little bit. So basically, in a traditional mortgage, typically wouldn't look like that. You typically be paying more in interest than you would be making as a payment here. And that by the 30th year, almost all of your payment um, would be going towards the interest. Oh wait, no, I'm sorry. I was misreading this. Sorry, I was just looking at this chart. I thought this was principal. Sorry, you're paying 1342 a month. Looks like you're paying 1342 a month for 30 years. So let's just do some simple math here. So for this $250,000 loan, you will, over the lifetime of the loan, have paid back $483,000. So that's pretty depressing, right? For you basically paid double what the house is because of a need to service that loan. And that for every $1,342 payment you make each and every month, in the very beginning, $1,042 of that is just to interest, which would mean that your balance only went down by $300. And then you go for, so now, right, you're now applying the interest amount, you're applying the interest rate to a balance that's $300 less. So you're not going to go down by $300. You can go down by just a little bit more than that. In this case, $302. And this process will continue on and on and on until when you make the 360th $1,342 payment, where only six of those dollars is being applied to the interest. It is why, under the traditional mortgage, they say that you're really doing yourself favors to the extent that you can prepay your mortgage, because any extra payment you make will go only towards the principal and not to interest, because you've essentially already paid the interest. Now, in the interest only mortgage, you can see here that the cost is less, right? You're going to only pay the interest. The balance stays the same. So it's at this point you've made 5 years of payments and you're still at a $250,000 balance. Right? Whereas here it's obviously going to be less than 250, something less than that. So you pay $1,042 for 5 years, covering just the interest. And then after 5 years, you pay a higher amount because now you're covering the interest plus the principal, plus the fact that you're paying it a little bit later. So now it's 1461 that you're making in payments, and by again the 30th year, you now make a $1,461 payment with only six of those dollars devoted to interest. And then the riskier would be the negatively amortized loan, where you can see that the interest payment or the payment is even less because now it's half of the interest amount. Half. But then you've got to pay back the other half of the interest, plus you got to pay back principal plus the ongoing interest, which is why now your payment jumps up to 1656 after year 5. Which is basically why I said that the interest only loan and negatively amortized loan tend to be used by people who are just going to flip the house, or are just using it for investment purposes. Now, as for the housing market bubble, um, before 2008, 2009, we had never had a national housing market bubble. People just thought it was impossible that we could have that bubbles could exist, but that they were regional, that they were in a specific location. Um, and obviously, the 2008 2009 crisis changed all that. The bubble emerges out of the fact that certain locations really rise to prominence. Like in a tech bubble, right? It was Silicon Valley, so San Francisco, um, and then even things like San Diego, San Jose, LA. And then on the other side, you've got like New York, Boston, which all have these um, location that's got a number of great employers, great schools or better schools, and people want to live there, driving um, housing values up. But that the other part of it too, and we especially saw this during COVID, is that the interest rates go really down. And when the interest rates are low, you can buy more house. As in my case. So when I bought my house, when I finally closed in November of 2000, my interest rate was 2.875%. It would continue to go down until December, so that next month it reached its low, which was 2.75%. And today it's over 4%. Well, what that means is that, when the bank is determining how much house you can buy, what they want to know is what's your income and how much of a loan payment can that income support. If the interest rates are higher, the loan payment amounts are going to be higher. In this case, the interest rate um, has increased by almost 30%, 40% from what it was when I got it. And so that would mean that the person cannot buy as much house as they used to. Um, but you also get into this kind of loop where everyone thinks that housing is the place to invest, and they keep pouring more and more money into it. And as they pour more and more money into it, that increased demand becomes a self-fulfilling prophecy because the house value goes up. So, right, what did we call that? Um, uh, um, um, what's the acronym for your fear of being left out? Right, um, that would be what's going on here. um, everyone rushes into the housing market because they feel like if they don't do something, they will be left out. So look at this. People's income in these major metropolitan areas are not increasing that much in that 12-year time span. But look at the housing values. From its peak in 2006, 2007, being now much greater than that. And then when you look at whether individuals can support um, those costs, what we see is that individuals are paying less in interest, at least in 2018. So the interest rate, rather than being 6%, is 4.25%, which does bring down, um, which does bring down um, housing cost burden as a percentage of income. But you still get this idea that people are going to be flooding into these housing markets because they feel like if they don't do something now, they're not going to get that good deal in the future. So, housing, even though the prices are as high as they were before the crisis, the housing market bubble started in 2008, 2009. The fact is that incomes are higher, and more importantly, mortgage interest rates are lower. Now that the mortgage interest rates are increasing and will continue to increase this year, those houses become so much less affordable than they used to be. So if we look at where housing is most affordable, I wouldn't want to live in any of these cities. I actually used to live kind of close to Davenport, Moline, Rock Island. It's called the Quad Cities. I used to live kind of close to there. I mean, there's riverboat gambling. There's not much there, though. John Deere is located there, as we talked about from the last lecture. I wouldn't want to live in any of these places, which I guess is why the housing is affordable. And then you look at these cities in California. A lot of those look pretty nice, and consequently, they're not. They are the least affordable in the United States. When we kind of update this then to understanding how things were different and how things changed with the 2008 2009 crisis, um, one of the problems that occurred was in the securitization process. So what was happening was that Fannie Mae and Freddie Mac, as I said earlier, they were buying up all these mortgages, right? And so they get all the details about the mortgage, the borrower, and whatnot from the bank. But remember, Fannie Mae and Freddie Mac don't know the borrowers, and importantly as well, the bank that made the mortgage knew they weren't going to be holding on to it because within a few days after the mortgage paperwork being completed by the bank had already sold the mortgage. So banks didn't really face an incentive to um, be careful about who they were lending to. So Fannie Mae and Freddie Mac are just buying all of these mortgages, just lots and lots of mortgages, and then they are bundling them together in tranches. And what these tranches do is um, it basically is a collection of mortgages that all pose about the same level of risk and are kind of spread out across multiple urban areas. So you've got a geographically diverse portfolio. And then those mortgage, those bundled mortgages that Fannie Mae and Freddie Mac hold, they're not going to hold them forever. They're going to sell them as a mortgage backed security, a mortgage backed bond to investors. I never bought a Fannie Mae or Freddie Mac bond, um, but I knew that they were out there. Now, if I bought this bond from Fannie Mae or Freddie Mac, and I were like an investment firm, or especially if I were something like an insurance company, I would need to also, beyond buying the bond, I would need to also buy a credit default swap. What the CDS does, or the credit default swap, what it does is it's basically insurance. It says essentially that if people, enough of the borrowers do not pay back their mortgage and the bond fails, I'll get all my money back. The problem that happened with the credit default swap is that only a few companies were offering that insurance, with the biggest one being AIG. ING, which was a Dutch bank, was also a pretty big player. That bank doesn't even exist anymore, largely because of the 2008 2009 crisis. Um, and AIG um, quite nearly failed, and we'll see that in a little bit more detail in the next lecture. And those credit default swaps, they weren't priced properly because most of the issuers of that insurance just thought it was incredibly um, it was not likely at all. The risk was very low to insuring a mortgage backed security, an MBS, because you just didn't see that kind of failure in the housing market. We never had, as I said, a national housing bubble. And since it's a geographically diverse bond, mortgage backed security, these credit default swaps were not priced properly. They were too cheap. The insurance was too cheap. And as I said, because the banks were selling these mortgages to Fannie Mae and Freddie Mac pretty quickly, the problems emerge when you had both the subprime mortgages, where individuals were borrowing money that they clearly didn't have and wouldn't, under normal circumstances, qualify for. And then you had what are called liar loans, which would be basically you didn't have to um, verify what your assets or income was. So let me tell you a story here. Um, my first job was in St. Louis. I got the job in 2005. Um, no money. I just got out of graduate school. I was pretty piss poor, and I'm moving to a new city. So the only thing I know how to do when I move to a new city is I find a frat brother. I was in a fraternity in college. I find a frat brother who lives in that area, who's basically gonna like set me up and help me out, and help me find a place to live, basically. And in St. Louis, um, one of my frat brothers lived there. So I, called him up and said, "Hey, I'm coming down to St. Louis. Got a job. Looking for a place. You got any ideas?" And he's like, "Yeah, I'll actually drive you around to a few places." I'm like, great, fantastic. Um, Picks me up at the airport, and it turns out that he owns places. Like he bought a whole bunch of houses, and he's renting them out. And he tried to be fair about it. He took me to other places as well. He didn't just take me to his. But then as the day was ending, he's like, "Hey, do you want me just to take you to this place? I'm just kind of finishing up." I was like, "Yeah, sure, why not?" And I looked at the house, and it was pretty nice. Now I remember him from college. Um, how do I put this nicely? He basically enjoyed college quite a bit, right? So he didn't study hard. He, enjoyed frat life. And I wondered, how the hell did he get the money for this house? Because it looked pretty nice. And fortunately, I don't have really the social graces to not like ask that question. So I just asked it directly. I said, "How did you afford this?" And he said, "Well, I put down $1,000 in earnest money, and that's how I bought the house." And I thought, he put down $1,000 to buy this house. Actually, I don't know. Maybe we can even see. Oh, what was my old address? Good question. Um, hmm, 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 hmm. I'm only gonna remember it based on the map here. I need to look at the map. Okay, so I live. Let's see. I'm in St. Louis here. Okay, so I was past Tower Grove Park. Sorry, we're in St. Louis here. Grand Avenue. Spring. Sorry, I'm trying to get my bearings here. Grand. Spring. Oh, here I am. Sorry. Spring. And was it by Utah? McDonald. I remember there was a big grocery store. There's the grocery store. Schnucks. Fairview. Down Fairview to Spring. Here we go. Here's my old house. Is this it? Can't tell. Like, why are you wasting our time looking at this? 3430, was that it? I think so. As much as I know. Actually, no, I can look at the picture here. Or maybe I can't. Or was it this house? No, that was the neighbor's house. That was the neighbor's. That I do know. They had a really nice house. No, that was definitely this house, the $204,000 one. Okay, well, let's look at what the value was over time. Well, I guess maybe it's gone up dramatically. Um, hmm, I guess. Where am I going with this? Well, yeah, it makes sense. The house was sold, so that's when he bought the house. So that makes sense. Um, yeah, it's not. You know, it was a sign for me that something was wrong with the housing market. That he should have been able to buy a house like that. Um, he just didn't have the income nor the assets to afford the monthly payments on that house. I lived there for 2 years, and he basically didn't have enough money to finish building out the rest of the apartment, so I actually had the entire building to myself, which isn't exactly ideal. I think they were just basically using my rent money to basically continue to make the mortgage payment. Um, and I don't think they own any of the places anymore. So, how did this all end? Right. So, by the time I left that house in 2007, the writing was on the wall. The problem became is that the houses had become unaffordable, and they became unaffordable because the central bank had started to raise interest rates in 2005 and in 2006. As the mortgages became more expensive, because the loans were not fixed rate mortgages but rather variable rate mortgages, people weren't able to make those payments. They put their house on the market to try to avoid going in default. All these houses on the market, then all that supply made the housing prices fall, which then caused people to even try to put houses on the market faster. And individuals weren't able to really borrow against their house like they were. Um, and instead, they found that the housing market just ended, that the bubble just burst way too quickly. Okay, let me pause right here. Um, so really, as the housing market, as that bubble burst for housing, um, it really lowered, it dramatically changed um, consumer confidence in the belief that housing is the surefire way to achieve prosperity in the United States. Um, but um, then with COVID, we seem to have forgotten that, and we seem to be back where we were before. And what's interesting now is that if there is a housing market bubble, it will burst again. And the same events are happening because right now, interest rates are starting to increase. As those interest rates start to increase, then we see the bubbles that exist for housing, for cars, um, for people borrowing for like margin accounts for the stock market. As interest rates go up, all of that, all of those risky ways that individuals are trying to make money, um, um, they have to start paying back those loans, and those loans are going to be more expensive. And as a result, a stock market bubble would burst, a housing market bubble would burst, even a used car market bubble would burst. Um, and we may be repeating what happened in the past. Let's just try to look at the data here a little bit differently. Let's look at it specifically for Hawaii. Um, Sorry, I'm just trying to look at where the data would be. So this would be all for Honolulu County. I mean, let's just look at this one here. I mean, look at that. Median sales price. dude, that's pretty rough. um, I don't know how you afford that. I really don't. It's just scary data. I really don't know what to say beyond that. It's just really scary data. And obviously, if you look at building permits, you're just, that obviously went down quite a bit during the pandemic. And even as more things are being built, you're still going to face the problem. Sorry, I guess. Okay. So you see that in single family homes, the reselling of existing homes, um, but then also look at the affordability, right? Is that the affordability is also that things are not as affordable as they once were. Um, People are earning more, and the amount they can borrow is higher, but it's not going to be enough to buy the house that they're trying to buy. Okay. So in the next lecture, this is going to be connected to it. In the next lecture, we're going to look more at the 2007, 2008, 2009 financial crisis and the way that the housing market is just one part of that crisis.